Alright, what's up, people? So today I'm going to be going over my trading for the day and the trades I took. I'll also be going over my bias going for the day and some things I did good, some things I could have done better, and whatnot. So let's get started. I'm just getting my screen pulled up, getting my journal pulled up. So going into the day was kind of a little bit different because price didn't really do much over the overnight session. And then we started ranging up during early New York. Yeah, we started ranging right around here. Early New York was ranging. London just steadily pushed up. So I was looking bearish, because of yesterday, showing this low resistance, low liquidity run from the consequent encroachment of this fair value gap. So I was looking for shorts coming into the day. That was just my bias, and the thing with the bias is it just kind of helps you filter out unnecessary trades. So if I was long, bias, the same thing I would have good trades because there still are models, like right here. We're tapping this inverse fair value gap, we get to the consequent encroachment. There are many models that are happening. It just helps you filter out and increases your probability when you're on the right side, because you can have a high probability of predicting the bias. So I was looking for a high to be taken out before going short. Let's see what I said in the morning on my journal, because I think I said something about what I was predicting. I'm more bullish than bearish. We just swept the high inside of a fair value gap, so could see a drop lower. So let's see. So when I said that, I said we swept these highs. We closed below this fair value gap without taking the internal low, which was this low right here, which was inside this fair value gap. So it's a good liquidity point as well to target. Price comes back in. I enter, predicting the change in state of delivery. Sorry. I enter, stop loss is like right here. Get stopped out. So the thing is I have to remember to myself that it is 9:30. Like, this is the 9:30 range, which we get lots of these wicks. You can go back every day, backtest it as much as you want, but we have lots of wicks because price is really volatile. So you have to be aware of that. You have to kind of predict the wicks, and you can predict the wicks easily. Take the highest wick, take the last wick, take that consequent encroachment, take this recent high as consequent encroachment, and price, you can just pretty much guess that price is going to come to this range, comes into this range, short. Really good traders would find a short here, and your stop loss would be lower. So you want to find the best stop loss. So here is not a good stop loss because you'd have to be right here, which is way too high. You're not risking 16 points. So yeah, that was a loss that I took. That kind of annoyed me for some reason because I just got stopped out really quickly, and I entered it with like a 1 mini. So I got stopped out like 200, and I only had 200 left to lose on my funded evaluation before it was like failing, because I took like some stupid losses last week. Yeah, but I predicted the bias right. I just have to get better at that. So then I wasn't really looking for a trade, but then we swept a high right here. Didn't really displace above it, as you can see. We didn't really displace above the high. We have lots of wicks, but as you can see, they're tapping into the consequent encroachment of this wick. Right there. Sorry. So I entered a short position because we swept internal high inside of an order block. We're reacting from the order block, the consequent encroachment. We do close above, but we got a quick close back under. Short right here. Just get stopped out. It's fine. Sometimes you're on the wrong side of probabilities. I'm not really mad about anything. I did not risk these heavy. Another thing you can notice here is we almost perfectly respect this consequent encroachment of this 1 minute fair value gap. So here comes the really, like, the advanced ICT concepts in a way. One second, need some water. So from here, it was obvious what I was looking for. This is a 3-minute fair value gap right here. There's a 3-minute fair value gap right here. There's a prominent high. When you look here, this is the high that took out. So this right here is a move that took out this high, which is a prominent high inside of a fair value gap. This took out the move that took out the high. And this took out the move that took out the move that took out the high. So this is there's lots of liquidity here. This is one way to put it. So when price comes above, and you're seeing this manipulation, and if you're looking here, I mean, you can tell me what it looks like. Accumulation. We're accumulating, moving sideways. Manipulation. Distribution. That's what it looks like, the power of 3. It's not always going to look textbook. It's sometimes hidden. So with this move, when we're not seeing like these high, like you can see here, this is a lot very energetic, and so this is very energetic. This reminds me, like, I'm not getting caught up in this long, seeing this break of structure, ICT 2022 model. You take a long right here because we're inside the fair value gap. Look at the reaction, dude. Reaction inside of a fair value gap, put it below, and you just get slaughtered. You have to notice when the manipulation is coming. And there's SMT up here with ES. We take out the high wicket before coming in, before we head any lower. When ES does not take that high, then as you can see, we react to the consequent encroachment of this fair value, this thing, rejection block. When we start to go lower, and then from here, after I saw this fair value gap that holds price, it has been holding price, gets inversed, and we get another change. It's more of a propulsion block, but I just call it a change in state of delivery. It's just the thing. This looks like a change in state of delivery, and sometimes you see it above, and sometimes you see it here when we close back under. But this can also be predicted. And when I see this, and I see this also inversed, it's higher probability that at least these relative equal lows are going to get hit in this side of a fair value gap. So here, some would be looking for long, but I'm looking to be short. So once this is inversed, it does show me that price is willing to go lower. On the 3-minute, it was pretty clean because there was one singular fair value gap, so I entered on the 3-minute, but with my stop on the 1-minute. So I entered when we came back into consequent encroachment, closing back above, but yet rejecting from it. Of this propulsion block, I entered short, and I put my stop loss kind of like around the consequent encroachment of this wick, but then I moved it away once price started to go lower, and eventually I moved it just to here, right? Price goes lower, and I took out half of my position. I thought price hit here, so I just took it out. So it was kind of like right here, I took it out, and then we rejected from there, came back down, and I actually sold right here some of my position, because as you can see, price inverse this. But then you have to think to yourself, what does this matter? We're on the 1-minute time frame. We're taking trades based on the 3-minute. 3-minute inverse this. If this was 3-minute, yes, it could be more powerful, but this is 1-minute. That is not as powerful. We are reacting from many order blocks inside of this range right here. So price is going to be a little sloppy, especially before a macro, not in a kill zone. So yeah, that was a good trade. Obviously, this is 22 points. This is life-changing amounts of money if you get this on a consistent basis. And then there's a fair value gap here. along with this. So this was rejecting from it, and so I shorted when price came back into the rejection of a consequent encroachment of this. Put my stop loss right here because I didn't really think price was going to come up here. You know, it could be, but showing this reaction along with this reaction, we're looking to go lower. And it was kind of not necessarily a gamble, but it was just a quick trade because I knew I was not going to let price go higher. Because let's say I'm on the 1 minute chart, and let's say price is coming up here, the 1 minute candle is going to close, and if the 1 minute candle closes above this right here, I'm out. So unless we get a huge move up, which we won't because there's all this resistance of orders right here, we're probably going to go lower. So you can take it that short right here and be confident that you'll be out of it soon. You know what I'm saying? So you take that short, it goes down. Here I'm targeting this, honestly, but once we inverse it, I'm willing to wait to wait for these relative equal lows to be hit, and then as they were about to be hit, you know, price just dropped lower and got my entry here, and I was out just because once you predict or once you just find your setup, I mean, there's no reason to go back out. I mean, yes, no, I didn't really gain that much money, but I mean, at this point, I haven't been gaining any money for so long now that, I mean, I don't care about the money. I mean, I'm just doing it to like be able to prove to myself that I can just do this day in and day out, just prove where the market's going, because I've been just consistently proving every week, in and out, the bias, daily, the bias. Been able to see these trades multiple directions every single day, specific times, day in, day out. I mean, I'm just here to be able to predict price consistently and in the best way I can, you know? I don't care about anything else. You know, let's get this going.